In this video, we will carry on and prepare the budgeted income statement and a budgeted balance sheet. Let's start with the budgeted income statement. Remember, sales were given at $70,000 for April, $75,000 for May, $100,000 for June. So when I add that together, for the quarter, $245,000. We are doing these for the quarter. For budgeted cost of goods sold, we want to start with the beginning inventory, which again, if we go back to our information at the beginning of the problem, our beginning inventory is the same as the end of March, $42,000. And then take a look at our purchases that we came up with in part 2. So as I go back up here to part 2, required purchases for the quarter were $172,350. So I will bring that on down. Okay, goods available for sale, just add those two numbers together. The most I could sell would be $214,350. However, I did have some in ending inventory. In other words, merchandise that I didn't sell. So I need to go back to part 2 and see what was the ending inventory on June 30th. So I will go back here to part 2. And ending inventory on June 30th, the end of the quarter, was $30,600. Okay, so I brought that down. So I will take the $214,350 minus the $30,600 to come up with that I actually sold $183,750. To get my gross margin, I'll take sales of $245,000 minus the cost of goods sold of $183,750, and that gives me $61,250. Now I want to bring down the expenses for the quarter, and I can go back to part 3 for that. So expenses included the commissions for all 3 months, April, May, and June. So if I go back, commissions for all 3 months was $29,400. Rent for all 3 months, which if I go back here to part 3, rent for all 3 months was $8,100. Now, remember, depreciation was a non-cash expense, but it is taken out of the income statement. So it wasn't part of our cash flow, but it is a non-cash expense. It's still taken out of the income statement. So therefore, I will need to take $990 a month times 3. Try that again here. 990 times 3 for a total of $2,970. And then for the other cash-related expenses, again, go back to part 3. That was $14,700. Okay, the next thing I will do is I will add all of those expenses. Okay, for $55,170. For net operating income, I will take my gross margin, subtract my total expenses. Now, remember when I did the cash budget? I had interest expense of $230, so I will bring that down. Okay, that is subtracted out, but I will put it in as it doesn't connect as a positive $230, but I will subtract, and that gives me a net income of $5,850. Next, I want to do a balance sheet, and this budgeted balance sheet will be as of June 30th. Okay, so let's start with our assets. Start with cash. So the cash balance on June 30th, if you go back to your cash budget that we did here, the ending balance at the end of the quarter on June 30th was $5,570. So I'll bring that down. Now, your account receivable balance at the end of June should be that 40% of June sales that will be paid in July. So June sales were 100,000, 40% will be paid in July, so it hasn't been paid yet. So therefore, your accounts receivable balance should be $40,000. Okay, and then our other current asset was inventory. So I will go back to part 2 again and get my inventory balance at the end of the quarter. At the end of the quarter on June 30th, my inventory balance is $30,600. Okay, I will then add my total assets for $76,170. For long-term assets, we had equipment. To get the net amount, that means after depreciation is taken out, is a little tricky. So if we go back to the beginning of the problem, we were given that the equipment balance net was $132,000. Remember when we did the cash budget, we purchased $1,900 more of equipment. So we would add that in to the $132,000. But remember when we did the budgeted income statement, we have this year $2,970 in depreciation expense that needs to be taken out. So 132, your beginning equipment balance, plus 1,900, the equipment purchased in April, minus the depreciation expense, gives you a net amount for equipment of $130,930. Okay, add the current assets plus the long term, and your total assets are $207,100. Okay, next let's go to our liabilities. Remember that we pay 1/2 in the current month, 1/2 in the next when we make purchases. So that means for June, we want to go back to June's purchases, which is $45,600. And you see if we go back here, to our purchases budget that we did in part 2, and look for June's purchases, the required purchases. June's required purchases were $45,600. Remember, 1/2 is paid in the current month, so 1/2 of that would be paid in June, but the other half of that would be paid in July. So that means that other half would remain in accounts payable. Okay, so therefore 1/2 of $45,600 is $22,800 for our accounts payable balance. Okay, the stockholders' equity was given at the beginning of the problem of $150,000, or I should say common stock was given $150,000. To get stockholders' equity, we're going to have to add in retained earnings to that. The beginning retained earnings was given to us at $28,450. We're going to add the net income from the budgeted income statement of $5,850. There were no dividends paid, so therefore we'll just add the two together for $34,300 and add those two together for stockholders' equity of $184,300. Add the liabilities and stockholders' equity, and it matches your total assets at $207,100. Thank you very much.